Welcome to the Madison Advisory AI Podcast. I'm your host, Verner Thompson. Today's conversation is about something many founders don't realize until it's too late. Private equity isn't the only path, and it may not even be the best one, depending on what you value. My guest, Brandt Brereton, has spent decades in lower middle market investment banking and now operates at the intersection of ESOPs, capital markets, and legacy-driven ownership transitions. We're going to talk about how owners default to private equity, what most advisors struggle to explain, and how ESOPs actually work in practice, where technology helps without replacing human judgment. Brandt, welcome. I'm glad we're continuing our conversation.
Thank you, Amanda. Great pleasure.
You've spent decades in the lower middle market investment banking space. When you look over the past 10 to 15 years, what changed enough that you decided traditional investment banking and that model wasn't where you wanted to spend the next chapters of your career?
The internet. I started in the business in 87 at bulge bracket firms, but then started a little boutique M&A shop with my dad in 95, and that was before the internet, people will recall. And where there's mystery, there's margin. And so it used to be that business owners had no idea who should buy them. They had no access to databases. There were very few databases in existence. So there was all this mystery around, who would be the buyers of the business, and the internet, emerged. And at the same time that the internet emerged, so this flood of data now in the hands of business owners. At the same time, the explosion of private equity groups began and occurred and continues to occur. And so now these business owners that used to kind of not know how to sell their business and you have to go to traditional investment banking shops and pay fees, we're getting, a stack of messages from private equity groups hammering them. And so it's like, why would I need an intermediary to sell the business when I've got all these phone calls to return? And so I think that probably was the biggest change in the market.
Yeah, and that's always a difficulty, showing the value where an intermediary really can help. But I like that the internet has played such a prominent role in your career development. A lot of our listeners may not be able to fully relate to that, but I'm sure some will.
Yes, gray hair.
When did you realize that ESOPs weren't just an alternative, but even perhaps a more strategic direction?
Great question. 08. So Obama came in. Remember the meltdown of 08? Obama became the president, and he raised tax rates for the first time in a really long time. And so the combination of higher taxes and lower valuations by virtue of the kind of the financial meltdown. And I'm sitting in the middle at the time. I'm on the Nevada side of Tahoe, Reno Tahoe area in the mountains, but I was in the middle of Silicon Valley and in California. And so it's like, highest tax rate state in the country. I'm focused on non-technology business owners, and their world just got rocked because valuations, multiples went way down, taxes went up, the amount that they keep from a sale was totally squeezed, and it caused me to really start thinking about this thing called an ESOP, which I didn't know anything about, and I was very guilty of doing what most advisors do now, which is just when you don't know something, you act like you do, or you obfuscate and you try to move on to the next topic that you know more about. But it just was pretty clear that baby boomers, this next 20 years of baby boomer retirement business owners were going to really be squeezed, and those that are in high tax states would perhaps be open-minded to alternatives that could put just as much money in their pocket as they'd hoped for.
And that makes a lot of sense. I didn't entirely appreciate that 2000 marker really as the big transition point in your judgment towards ESOPs, but that does make a whole lot of sense. And wearing my investment banker hat, I know there's always a spectrum of trade-offs that potential sellers review, and that you do show potential sellers in a transaction. In your opinion, where do you think sellers often misjudge the trade-offs?
Another great question. Yeah, so 40 years of doing this gives you the benefit of retrospective wisdom, for lack of a better term, and I see it as a spectrum of lower middle market business owners, sellers, and on one end of the spectrum are people that want as much cash as they can possibly get, and just as important, they want to shift as much of the business risk to that buyer as fast as possible. And those people should sell to public companies or to big, well-heeled strategic buyers that can pay the most, justify paying the most, and get the cash, and you're really not sharing much of the go-forward risk. And then there's the vast majority of the business owners that are in the middle of that spectrum that are selling to private equity groups, most of which I maintain for the wrong reason, and I'll unpack that in a sec, some of which for the right reason. And then on the very extreme end of that spectrum is the ESOP transaction, employee stock ownership plan, employee stock ownership trust, as a corporate trust that buys the stock as an alternative, the sort of obscure corner of the capital markets. And it used to be that, incidentally, that you had to kind of be a saint to do the ESOP. Like, you had to really care so much about the culture of the business and perpetuating the independence of that you were willing to sell to the ESOP at the same valuation that you could sell to the private equity group for, but you didn't get as much cash at close because structured equity funds didn't exist back then. They do now by virtue of our fund. And so in the middle, let me just take a second, talk about the middle, and then I'll come back to the right end of the spectrum. But if you look at the returns of private equity funds as an asset class over the last, say, 20 years, what you see is that the people at the very right end of the bell curve, the people that are just crushing it from a return perspective, have one thing in common. Those funds are managed by general partners that have have demonstrable track record of operating a business in the industry that fund is investing in. So they know, they've been around the corners, they know exactly what to do with that business to really take it to the next level. In my view, that's the only reason that a business owner should sell to a private equity group, because liquidity is ubiquitous. Mm-hmm. If all you're trying to do is get liquidity, selling to the private equity group is the easiest thing to do because there's so many of them swamping the boat and seducing, but I don't think it's the best decision from a corporate finance perspective. Unless you're trying to get that help, operational help, you're rolling over a substantial amount of equity, you really care about that second bite, and you've got high confidence level that your financial partners are going to help you get there. But the vast majority of the private equity groups that are calling on lower middle market business owners don't have that experience. They just have money, and they understand how the LBO works, and it's like there's a better way to do it for sure. So now you go over to the right end of the spectrum with this ESOP, and it used to be that the liquidity that one receives from selling to the ESOP is limited to the senior lender. So a bank with collateral lending restrained amount of money into the transaction was the amount of cash that you were going to get, and the difference that you were going to carry back in a seller note. Well, there's lots of people. So if you move one quadrant to the left of that end point on the spectrum, there are thousands of companies that care a lot about the culture that they've built, the legacy. By now, they've heard a lot of bad stories about their friends getting burned by private equity and getting fired, et cetera. And so for them to learn that there's a new alternative where you can sell to the ESOP with all of those advantages and now get the same amount of cash at close that you could get by selling to the private equity group by virtue of a custom subordinated debt lender that's ESOP savvy that can make it work and drive private equity style returns to the investors. That's the way to do it. So if you move one quadrant to the left of that endpoint where the ESOPs are happening, there are thousands of lower middle market business owners that with the new knowledge that they can sell to the ESOP with all of those advantages, retain control, not deal with private equity guys, and get the same amount of cash to close now by virtue of our structured equity fund and funds like ours that are popping up. That's a blue ocean strategy that we're pursuing. So there's a big market opportunity for companies to look for the alternative to private equity, get the same economics, and enjoy all of the control and tax benefits of the ESOP transaction.
And I think I may know the answer to this, but why does, knowing that this blue ocean, if you will, exists, why does private equity still remain the default option?
CPAs that were practicing in the 70s and early 80s when these laws first came out, remember this was sort of pre-Reagan, pre-deregulation, pre-tax cuts, pre-bull market that's continued since then. It was a pretty dismal capital markets environment back then. The CPAs that were practicing during that period of time saw it as a huge opportunity and were proponents. Then 20 private equity groups globally in 95 turned into 14,000 today. Those CPAs retired. My son's a CPA, so he validates this hypothesis of mine that they're too busy. They can't even keep up with their continuing professional education courses, let alone dust off the ESOP book. There's no reason for them to do that, right? There's just so much private equity flowing into their clientele, and everybody's making so much money just responding to the transaction activity that's being driven by private equity that nobody has any time to look at anything different. The problem with that is that these CPA firms themselves are baby boomers. They themselves are trying to solve their own liquidity event because of their baby boomers, and their clients are baby boomers. So all of this is sort of inside this baby boomer demographical driver that's happening in our capital markets. And so if they were smart, which is the reason why I wrote the book, if they're smart, they would become experts on ESOP, and some have, by the way. BDO just did ESOP themselves. There's other big names coming. So people are starting to wake up to this. And if they were smart, they would embrace the new ESOP structure because it's a way for them to help their clients achieve the liquidity and not lose clients to attrition when private equity groups buy them and plug them into whoever their CPA firm is. So really the CPA is the most trusted advisor in the lower middle market, and for the last 20 years they haven't had to pay attention to it. With rare exception, there are some that really get it and are huge proponents, but most of them are just too busy practicing, and they do today what I did 20 years ago, which is when you get asked a question about the ESOP, you say it's too expensive, it's too complicated. You start rattling off all these things to obfuscate and move on to talking about something that you are an expert in.
That you're a little bit more educated on. I think that drives into my next question, which is more focused on the banker perspective. Besides the CPAs, a lot of lower middle market firms are working with boutique or other investment bankers. And why do you think from an investment banker perspective that there's a confidence gap in explaining ESOPs.
They just haven't they haven't studied it. And so it's human nature. When you're supposed to know something and people are paying you a lot of money to know something, you don't know it, it's embarrassing. And so it's self-preservation, right? So you obfuscate, and so they just don't know. They don't understand it. So we've actually spent, in this last year, last calendar year, we had really lengthy, healthy conversations with a couple of sizable M&A shops that really wanted to kind of understand what this new alternative could look like. And admittedly, it's with their stuck deals, right? Every banker's got a couple of deals in their pipeline that are stuck for whatever reason. So it's like, okay, well, how do I get this deal done, meet my numbers for the year? Let me talk to Brandt, understand this whole ESOP thing. And so we've done a totally very open education on exactly how it works, how to do it. So it's not, we're trying to create more educated advisors out there that can see what can be done and then have them come to us for the capital, and we can help them in the background on the nuances.
And I think education is a key component to being able to explain the ESOP option accurately. So I want to go in two directions here. The first one is for our listeners that are ESOP level of elementary school and want to get to 8th grade. How would you explain an ESOP structure in 8th grade English to an owner that's listening that may pursue it?
So how the first thing I would say is that don't believe what you've heard about ESOPs, because there's tons of misconceptions propagated by people like me before investment bankers, for what we just talked about. But how we have a family trust. We put our money, all of our assets, in a family trust, and our kids and our grandkids are the beneficiaries of that trust. They can't get their hands on the assets and make buy-sell decisions, but they just get money from the trust based on how the trust agreement reads. That is exactly what an ESOP is. It is a trust. At the same time, it's also a qualified retirement plan, like a profit sharing plan, but it's a trust. And so the trust is the buyer of the stock that you sell, not a third party that's going to come in and try to get control of the board and make all these decisions and dictate pace and return on investment and all that stuff. But it's a captive retirement plan that the board of the corporation is the corporation is the sponsor. The board effectively controls it, subject to a trustee, and the board can be the trustee of it. And so it's this inside buyer of the stock. And once you kind of understand that, and once you understand that the employees have no say in nothing changes. The only thing that changes in the ESOP structure is the shareholders. That is all. And then you have to have an independent board member on your board. But other than that, nothing really changes. And so if you're just selling your stock to a trust that you effectively control, subject to a trustee, and now with just as much capital and cash at close, you're doing your own private equity transaction, is the simplest way to think about it.
That is a very simple way of putting it. I think that's effective.
Yes.
And with that knowledge, as sitting in the owner's seat, how does that impact your decision tree when you're thinking about different options?
When you say options, do you mean liquidity event options?
Liquidity event options, exactly, yes.
Yeah, I think it goes back to that spectrum analogy, right? I mean, it kind of depends, what are you trying to solve for? Are you solving for maximum cash and, more importantly, business execution risk mitigation? The ESOP's not the answer. Sell it to the big public company. If you're trying to get to the next level, again, be very, very selective. So this is where investment bankers like you can provide so much value to the client by screening the list of private equity groups that are going to be part of the process and limiting it to only those that have a demonstrable track record and success with that business, and screening away all the BS and the noise that's where an investment banker can add tons of value now. But most business owners are too naive to even understand that. And so they're just responding and being seduced by all this money that's coming. They don't know how to distinguish between those things. But that's where investment bankers can add a ton of value. And then if it's, I can't stand the notion of dealing with private equity guys that are going to come in and change. They're going to tell me what I want to hear, and then they're going to change everything. Some people don't care. Yeah, whatever.
Yeah.
If I can make money, that's great. But if you care, like if you really care about it, then you owe it to yourself to understand a comparative analysis of here's what a private equity deal would look like on my deal. Here's what a perpetuate financed ESOP transaction could look like in this deal. Spend a couple of hours understanding the algebra, and then you can make a decision about what you should do. Maybe it's not for everybody. I would say it's not for everybody. Mm-hmm. But what is for everybody is understanding that difference.
And it does seem like awareness and education are really the biggest hurdle, perhaps, in your market. How are you approaching that hurdle?
Not well, I guess. I don't know. It's so, it's hard enough to raise money, with a complicated story. It's not just another plain vanilla private equity kind of a fund. You have to really explain it, and so it's hard, And so it's the job is difficult to take something complex, make it simple, make it competitive, and then I had totally underestimated. You would think that if you did something so special, so cool, that people would be banging your door down. Yeah, I heard about this, but you still have this massive challenge of education, of marketing, getting the message out. This is something. This exists. This is a great alternative. Here's some success stories, some case studies, and the blocking and tackling of the actual marketing in a digital marketing environment is a challenge. So that's why I'm willing to do this. Get on podcasts and tell the story to whoever is interested in hearing about alternatives to private equity.
And I think that's great. I do think our listeners will have heard of ESOPs before and think they understand them, but I think this will give a fresh perspective for how to approach the ESOP structure, certainly.
Traditional mezzanine capital does not match with the ESOP transaction. Way too high claim on cash in terms of coupons on their loans and warrants. They're just too greedy. You have to take a private equity risk reward decision to do this. And so you have to take a lower interest rate. You have to take interest only for a much longer period of time. You have to design a transaction that allows the company to grind down the senior debt first while you're servicing the interest on us in the middle and the seller notes below us. Then take us down at the same time that you're taking the seller note down. And now, year 7, year 8, you've got a relatively unlevered balance sheet. And worst case scenario, if you've not generated enough free cash flow with no tax burden over 8 years to fund a warrant strike, you've got an unlevered balance sheet that allows you to borrow on a senior basis only to fund the warrant strike to us and the warrant strike to you, the seller note holder. And by design, that company never has to be sold to somebody else to drive returns. So it's very, very elegant in that regard.
It is elegant and it's nuanced, but when you look at the market, and all of the opportunity there is, especially with private equity coming in, how much interest there are from, like you called it, the boomers, as they exit, perhaps. What does success look like in your mind of properly educating the market about the ESOP option?
Way more companies doing it, bigger companies doing it. So BDO, BDO I think was like the number 7 CPA firm. They just last year they did a partial ESOP transaction with senior and junior debt. My buddy did that transaction. I didn't do it. So kind of the smart money is starting to get it. And the other thing I would say is that there's an organization, and I'm probably going to get it wrong. I think it's called Ownership Labs. I'm going to get it wrong. I'll try to look it up before we hang up here. But they're out of Berkeley. But it's effectively a think tank. They exist to quantify how many capital providers are focused on EO, employee ownership, and there's a spectrum of us. And to my pleasant surprise, I think there's like a dozen capital providers now, and there was 5 years from now there was 2, us and Mosaic, and so their mandate is to educate institutional investors on this area of capital provision, and they seem to be doing a really good job. And so there's pending legislation in Congress to provide SBIC type leverage to ESOP focused capital providers and advisors like us that I hope will clear through this session. That'd be awesome. I mean, you have to provide financial incentives to capital providers to allocate the capital to these types of transactions, notwithstanding the educational curve to come up. And that's what will really move the needle on this. And
it wouldn't be the Madison Advisory AI podcast if I didn't touch on technology to some extent. How has AI and technology impacted the way you're approaching your clients and ESOPs?
I think it's pretty cool, but I'm a boomer. My kids say you're a boomer, Dad, and so all of that's relative to a boomer. I use my AI note taker on virtually every single call I do. When you hear something complicated like the ESOP structure, you kind of have to hear it 3 times. You can be a really smart person, but you have to hear it 3 times for it to really sink. It's like algebra. You didn't understand algebra on day 1 in junior high school or high school. It takes a week or 2 or 3. You got to spend 8 hours kind of understanding some of those basics. And so I literally used to have to do these whiteboard sessions, educational sessions 3 times for people. And I just kind of, it's like, got burned out. And I did a call, and this young kid had an AI note taker on the call. I'm like, what is that? And he explained to me, and I'm like, that day I signed up for it, and every one of my calls is that way. So I do it once, and then send the video and the transcription to them. They get to hear it over and over and over again. So that's helped in a really, really big way. My youngest son is kind of an AI guru for a fintech company in San Francisco, and he has told me that he could AI automate virtually all of the front end of the investment banking and capital provision business. Maybe that's true, maybe that's not. I don't really know, but I bit, and so I hired him to build a tool that we're about to launch this month on our website, and people will see it on LinkedIn, where you type it, you put your information in, name, email, request an NDA. It'll spit a unilateral NDA signed by me to you. Now you can comfortably answer 5 or 6 questions in a form. Hit whatever the button is, and it'll say, here's what a typical private equity transaction is going to look like for you with a 20% rollover versus what a structured equity financed ESOP transaction would look like side by side, quantitative So pros and cons, advantages and disadvantages, quantitative and qualitative. And for the very first time, in a matter of a half an hour, somebody can say, wow, I had no idea, so I want to learn more about that. What do I need to do to learn more about that? And so that's an AI-driven product that we're about to launch. And so for boomers, I feel like we're adopting it at an appropriate pace.
And that's great. I think that'll be really effective, especially just getting over the first small hurdle of what does this look like side by side? Is this something I'd even be interested in?
That's because that is the only on-ramp. Only is too strong of a word. That's the best on-ramp for somebody to understand this new ESOP alternative is based on what they probably have seen before or what they're about to see when they get the LOI from the 3 private equity groups that are hammering them. And so that contextual side-by-side analysis is the best way for the brain to kind of get it, I think.
And if they're on your website, they may have already received those offers from private equity and are trying to explore. So that's always good to have.
Almost always.
And I think we've run through this a bit, but that's a great entryway of using AI as to show the side-by-side. When it comes to your take on technology and AI, where do you draw the line between human judgment versus what can be automated?
Hard question. I don't know the answer to that. I mean, I think we're all figuring that out. Is really the answer to that question. I think that in plain vanilla M&A, which is to say selling a private company to a public company or a private equity group, that is such a well-worn path that I can see that AI will disrupt a lot of those lower level analysts that do all that grunt work. I mean, I think there's going to be some really significant strides to be made in the investment banking model. Again, where there's mystery, there's margin. Where there's complexity, where there's nuance, I think it's way harder to do. Mm-hmm. And so I feel like in advising on ESOP transactions, it's so nuanced that I'm not saying it's never going to happen, but it's a ways off.
And I can see that. And I love your through line there, that where there's mystery, there's margin. That's true. To sum up our time here, what is, if we have someone listening that is an owner or elsewhere, what's one misconception that you think owners should unlearn before they end this podcast?
The number one thing that I hear from when somebody talks about an ESOP is the business owner says, my employees could never run this company. And even if they could, they don't have the money. Nothing could be farther from the truth. The employees aren't going to run the company. They have no say in the operations of the business. You don't have to have an internal successor to you in the business before you do the transaction. Private equity groups don't have every replacement CEO sitting on a bench waiting to be put into the deal. Right? What do we do? What do we all do? We go hire a retained search firm to create a panel of CEO or CFO candidates, and you make that replacement. The same exact thing is done in ESOP transactions, but nobody thinks that, right? And so there's that, and then people think that the employees either have to have money or they have enhanced rights in the business, and they're going to tell management how to run the business. Nothing could be farther from the truth. They have no additional say. They have no additional influence in the operations of the business. And so I think once those couple of misconceptions get cleared up, and then the third, they learn that there's a capital source that can give them the same amount of capital. They're not making a sacrifice anymore. Bulbs go on.
Well, those are three really grounding ways to end the discussion that we've had here, and I really appreciate your time today. We'll add your contact information and ways that people can reach out to you in the show notes. And I want to thank the listeners for listening to Madison Advisory AI's podcast, where we keep insights and capital intersection real and no hype. Thank you, everyone.